What's up everybody, welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony, let's jump in. Okay, happy Tuesday everybody. The Shanghai lockdown has partially begun, with the territory east of the Huangpu River in lockdown as of yesterday, Monday morning, 5 a.m. The larger population of about 14 million residents living west of the river is scheduled to join them in lockdown in a few days on the 1st of April. That is this Friday. I am learning from my sources, however, that this time may be brought forward to an earlier date, but this is not confirmed. As of the filming of this, the official date for that lockdown begins on the 1st of April. According to local officials, in areas affected, closed-off management will take place in residential communities, and residents will be allowed to stay indoors, while non-contact delivery of necessities will also be allowed. All businesses, quote, except those necessary for ensuring the people's daily needs and the city's operation, end quote, will run under closed-off management or have their employees work from home. Services including the bus, subway, ferry, taxi, and online ride-hailing are suspended. As we discussed yesterday, this decision to go into lockdown is a massive policy U-turn for the city. The financial hub had earlier denied that it was planning a citywide lockdown. As recently as Saturday, local health officials said Shanghai would not go into full lockdown, as this would negatively affect the national and global economies. We discussed this with Sunday's episode. The sudden shift suggests that there could well have been pressure from the central government in Beijing. There are already reports of food shortages in the city too. Vegetables and fresh food is unavailable in some parts of the city, and many places are closed. The food shortages currently do not appear to be as acute as what we saw in Xi'an during its lockdown last year. Shanghai is a highly developed urban center by mainland standards and should perform better than lower-tier cities in this regard. Domestic Chinese media itself, though, does recognize that this is an issue. Quote, several sources in the online grocery delivery sector said the problem isn't a shortage of food, but a shortage of logistics staff who can actually make it into work. About a third of delivery drivers and warehouse staff are unable to work, a source at one platform said. A source at another company said many of its delivery drivers are in isolation, leaving the company without the manpower to make all its deliveries. End quote. Authorities are allowing some manufacturers to run so-called closed-loop systems where employees are able to keep working as long as they're confined to the factory campus. The system is being used to keep some key facilities operating with skeleton crews, like parts of Pudong Airport and the Yangshan Port. But if cases are discovered, these critical places could be shut down further. Despite all this, however, as predicted, the economic disruptions are causing frustration for businesses, both locally as well as international enterprises. The Tesla Gigafactory, for example, has halted production for this week. And this is what the president of the European Union Chamber of Commerce in China expressed yesterday to Hong Kong media. Quote, while the majority of G20 countries are exiting pandemic-related lockdowns, China appears to be stuck with its old toolbox of zero tolerance and draconian measures to fight COVID. We fear that we may be about to witness the beginning of an Omicron crisis across China. End quote. Before the lockdowns from this week, some banks had already lowered their forecast for Chinese GDP growth this quarter to 0%. Analysts will be lowering these again this week, and it won't be pretty. We'll be unpacking this data in the next few days. While most eyes are on the economically critical megacity of Shanghai, we need to remember that there are other outbreaks across the country too, with tens of millions of people in other regions under varying forms of lockdown or restrictions. The outbreak in Jilin in the northeast of the country looks to be more concerning than what we're seeing in Shanghai, with more severe lockdowns. The province has started testing COVID patients with Pfizer Inc.'s new COVID-19 pill, the first time that the COVID-19 oral drug has been used on the Chinese mainland. The drug arrived in the province on Sunday night. Official daily cases in China have risen again, with almost 7,000 cases yesterday officially recognized by officials across the country. I know there are many people who listen to China Update that are based in China, including many in Shanghai. I'd love to hear what your experience is like on the ground, especially if you're in one of these cities that have been affected in recent days or recent weeks by lockdown orders. If you feel comfortable, it'd be wonderful to hear what your experience is down below. And wherever you are, I hope you're keeping safe, keeping sane, and I hope you're getting through this okay. Okay, next up, moving from a domestic crisis to an international one, we've already done deep dives into the nature of China's evolving position on the Ukraine war, as well as its relationship with Russia. For this video, let's touch on some key developments from the last few days in relation to these themes. US media is reporting that Chinese diplomats in Washington have been in contact with US counterparts asking for, quote, granular details on the sanctions, end quote, the sanctions against Russia here, which has, quote, encouraged US officials, even though they remain wary that China may simply be looking for loopholes to help Russia, end quote. China's general stance, that is publicly calling for peace while refusing to push against Russia, has remained largely the same. Anti-Americanism, both in domestic media and internationally, has slowly intensified too. To give an example, Deputy Foreign Minister Le Yucheng, who we've quoted several times in the past and who I predict will be in line for the future position of Foreign Minister to replace Wang Yi after he leaves the role, recently told a gathering of China's prestigious Tsinghua University that, quote, arms dealers, bankers, and oil tycoons from the United States are making fortunes out of the war while Ukraine suffers, end quote, suggesting that the US is intentionally drawing out the conflict for its own benefit. People's Liberation Army media, the states or the party's military arm media, traditionally very hawkish, has been far less diplomatic in pushing content critical of the United States. Over the last week, the publication China Military published a series of articles attacking the United States. We shouldn't be too surprised by the military-run state media producing this sort of content domestically. But what's interesting is that all of these articles have been translated into English and pushed overseas too. Here is the language which the publication employed, quote, when the Ukraine crisis is weighing on our minds, the US, the initiator of this crisis, is picking up its old trade of blame shifting and buck passing in the attempt to mislead the public, scapegoat other countries, and divert attention from its accountability by fabricating and spreading disinformation, end quote. Now, frankly, while China wants to avoid alienating Europe or angering Moscow, and while it will likely pour resources into its international PR work to advance a softer image, something we've seen with increasing regularity over the last few years, it's likely that some Beijing policymakers and leaders see benefit in the US being drawn into a renewed competition with Russia in Europe, a move which, it's argued, would draw attention and resources away from the East Pacific and towards this part of the world. However, this may just be wishful thinking. The crisis in Ukraine may ultimately rejuvenate NATO and shake awake many policymakers and politicians around the world to the risks of global strategic competition generally. Ultimately, this will likely lead to more attention on the security risks and geopolitical fault lines in East, Southeast, and South Asia, not less. Okay, last up, the Evergrande Housing Crisis, and we're going to be looking at the behavior and the reasoning of some contrarian investors that still think it's a good bet to put their money into Chinese developers. If you're enjoying the content, as always guys, it's a huge help if you hit the like button. I really appreciate it if you can just hit that like. It really helps a small channel like this. If you're watching for the first time and you're getting some value from this episode, I put one of these out every day. If you're interested in following it, hit subscribe, hit that bell notification. You'll have the most up-to-date analysis on China as it's released every day. Okay, moving on. Yesterday we discussed how global debt markets have shunned Chinese developers with investor and lender confidence in the sector at all-time lows. However, there is still a small group of international players who are willing to wade into the dark and murky waters of this housing crisis mess. In one recent post on Chinese messaging app WeChat, Howard Marks, co-founder of Oaktree Capital Management, the same Oaktree which made headlines in January for taking Evergrande's so-called Project Castle in Hong Kong, expressed, quote, losing sight of those long-term prospects because of the desire to avoid short-term volatility can result in investors missing out on great opportunities. Your entry price matters, and today's climate should lead to many attractive entry points. End quote. California-based Oaktree has made more than $4.7 billion worth of investments in China and has set up offices in both Shanghai and the capital. According to the firm, it is still actively working on deals to finance crisis-hit real estate companies. The company remains very bullish on China and the property industry. Howard Marks, in a separate interview, expressed that for China, quote, "the future is bright," end quote, with Evergrande 2025 bonds trading at 13 cents on the dollar and international financing of Chinese developers down over 90% year on year for the first 2 months of this year. Oaktree's optimistic outlook is very much a contrarian position in the current market. Another player still in the game is Hong Kong-based money manager Value Partners, expressing recently to investors that a 7-month slump in Chinese junk bonds has created a rare opportunity to scoop up bargains, especially in the property sector. Quote, "We are concentrating on buying names that are considered benchmarks and also those that provide good liquidity to the market when we have to exit. We are also actively involved in names that have unique events around them." End quote. Under IP's management, Value Partners' Greater China High Yield Income Fund has brought up cheap Chinese property bonds, almost tripling their portfolio's exposure to the troubled asset class from 12% in November of last year to 30% of the fund's assets now. The fund is around $1.3 billion in size, and as of the 24th of March has declined 22% since the start of the year and 18.4% year on year. IP argues that due to so many companies defaulting on debt obligations, prices have declined while risk premium, quote, "has widened to the highest levels in more than a decade," end quote, and that what the market is seeing is simply panic selling, which is typically followed by a rebound. IP is thus betting on a strong rebound and market recovery. While this is indeed a common trend that investors see after cyclical downturns, if the current Evergrande housing crisis turns out to be a structural downturn rather than a cyclical one, then it can be devastating to investors who bet on the latter. However, some of the contrarian investors that we've been looking at and others may not be making a bet on the business case of the property sector, but rather a bet on the political case. As we have discussed in previous episodes, Beijing policymakers do still have the tools to pump the housing sector up for a few more years if the pain from deleveraging and much-needed reform becomes too unbearable. Though this is very unhealthy, unsustainable, and simply postpones the issues, it could well result in the short term in a sufficiently decent return for those investors as prices jump back up from distressed and fire sale levels. We will learn in the following months whether these very risky bets pay off. Hey guys, I'd love to hear what you thought about some of the updates we covered in today's episode, so throw your comments below. Always love hearing from you. Thank you for watching. I'll see you next time.